I feel like this is extremely exciting. Every week that we're seeing is a new piece of history. We kind of sent over the agenda earlier, but we're going to get a dig in on, everything that's happening in the markets, give you a full update. But we're going to start quickly with intros for everybody that's new. Thank you so much for everybody that's new. Thank you so much for joining. We're going to introduce ourselves and we're going to hop into the agenda. So I am Jeremy. Hello, I am the moderator. I am the co-founder here at Equilibrium Ventures. My background is actually more Silicon Valley. I've built a number of successful real estate companies. My first venture, Spot Hero, is an app that allows drivers to reserve parking spots. It's generated lifetime sales in excess of $500 million. I've always had a passion for capital markets, and that's led me to spend a lot of time with Equi, who is going to be our host for today. So Ittai's got a very rich history in capital markets. He's started a wealth management practice that oversees in excess of $100 million. He also started an options-based hedge fund that had a great performance with zero correlation to the stock market, almost zero correlation. He's our capital markets expert, and the goal today is to make this session interactive. I know that I'm talking at all of you right now, but what we're going to do is have little breaks where everybody can ask questions, where we can dig into the things that are on your mind. So you'll all have an opportunity to ask publicly. Additionally, if you have any other questions in your screen, you'll see at the bottom corner or the bottom of your screen, there's a chat feature. I'm Jeremy Smith. You can just send me a message directly. And what that'll do is I'll be able to either answer the question for you or make sure we talk about it. So with that said, let's just talk about the agenda. So it's been another week, another massive monetary injection by the Fed. They're putting 2.3 trillion into the system, and they're buying ETFs for the first time. So that's a big deal, and we're going to show you what they're buying. I know a lot of you are thinking, as investors, did I miss the bottom? Or is this just a bear market rally? And we're going to kind of walk you through a little bit of the history of these bear market rallies and what the bottoms really look like. We'll talk about negative correlation between the S&P 500 and the VIX and how you can use that to your advantage. Plus, based on some of the feedback that we got from the last call, we want to show everybody in the audience how you can get your own introduction into hedging and using options. So it's kind of a way that you can take some of that volatility and potentially use it to your benefit. Lastly, we'll have a special guest speaker. This is Investment Banking Director Edward Kim, who will discuss his portfolio companies and how they're faring in the current economic environment. So Mr. Kim, thank you so much for joining. And with that agenda, it's time for me to stop talking. Itai, why don't you tell us about this big monetary injection and why the Fed just put another 2.3 trillion into the market?
Yeah, Jeremy, thank you so much for that nice introduction, as always. I think this week, we keep breaking records, right? Every time it seems like we're coming in and saying, this week was really a crazy week. Something that's never happened before is now happening. And I hate to say that, but that's kind of what's happening again. So the Fed did announce last week on Thursday that they're going to buy $2.3 trillion. They're going to inject $2.3 trillion again into the economy. Some will monetize the same things as they were monetizing before as far as the QE programs and things like that. So it feels like in 2008, for the first time, when the Fed introduced the QE programs, what they did is they basically create new money in order to fund government deficits. So if the government needs to spend more money, they're issuing these treasury bonds, and then basically the Fed buys those bonds and therefore helps the government run these bigger deficits. What's happening right now is essentially different. The Fed is saying we're going to buy corporate bonds and actually high yield bond ETFs. And what we're doing is monetizing corporations and companies, and not only government, or basically the US government. So I wanted to show you guys how this looks like. We've spoken about a couple of weeks ago about the Fed and how the Fed correlates to the markets. And this is a slide some of you may be familiar with. You see here in the red, the S&P 500 starting here in 2008. And in blue is the Federal Reserve balance sheet and the amount of money that the Fed has been monetizing. This is actually the rate of change of asset purchases that the Fed is doing, with zero here being the $0 amount, and this is measured in the trillions. look at this level of increase in the Fed balance sheet that we're seeing this year. It's really unprecedented. We haven't seen anything like that even in 2008. Why I think this is even more important, as we said, the Fed is buying junk bonds. It's buying corporate bonds. This is the list of ETFs that is currently being purchased by the Fed. So we can see here all the corporate bonds. I know a lot of people are familiar with LQD. It's the largest corporate bond ETF that we have. But here, look at the list here, high yield bonds. Why I think this is super interesting, companies can be divided into two. You have these investment grade companies, and then you have these higher yield. There are different ratings, but that's generally how it's divided. You have those that are more fiscally responsible. They're more stable. They're more mature. They have a handle of their debt. They're profitable, so they can easily service their debt, and they're highly rated. So the Fed is buying ETFs that sponsor those. But they're also sponsoring companies that possibly are not as profitable. They have a large debt burden, and they may not be the most responsible. So why I'm thinking this could be a big milestone for what we could have down the line is that it brings about that question that, yes, in the short run, if they're monetizing the debt of these companies, they're more likely to have access to funding, and they're not going to necessarily need to let people go, and they'll be able to hold through. But in the long run, all these things that we heard in 2008 about the too big to fail, what does this mean to corporate responsibility, or whether or not they're going to think, and down the line, I don't have to be in my best behavior, right? In capitalism, if you don't run a good business, if you don't run a tight ship, and you have too much debt, and you've tried to do things in not the best of way, you could potentially default and you're out. What's going to happen here?
Yeah. Itai, just to help us understand, what are some of the holdings that might go into some of these ETFs? Like, let's say junk. What is that? What's it holding? Like, which companies?
So we can look here into junk holdings that we actually have. So we can actually see what kind of bonds the Fed is buying now. So we have things like T-Mobile. We have things like Vodafone, Netflix, Dish Networks, SS&C Technologies. So when I had my hedge fund, they were actually our administrator. So this is a company that administers hedge funds. Kraft Heinz Foods, all these different things that I don't know why the Federal Reserve should have any saying into monetizing these companies. But you know what? This is the new reality that we're in, and I think we all need to acknowledge that this is what's happening right now.
Itai, we got a question from Rob. He wanted to know, is this the first time that they're buying ETFs? And also, are they only buying bond ETFs, or is there anything else like equity that they're purchasing as well?
So as I know, as of right now, there are no equity purchases, but who knows? The next crisis that we're going to have, or the next leg down, that could be the case too. I mean, the Bank of Japan is doing it and has been doing it. They've been buying equity ETFs. So far, this is the first time. Well, the Fed has already announced that they'll buy the LQD ETF. I think that was a couple of weeks ago. But this is the first time they're openly monetizing these corporate ETFs. That is a first, as far as I know. I do know it happened in Japan, but as far as what we're doing here, this is a first.
Cool. All right. Any other questions from the audience? All right, Itai, you want to go on to the next one?
Well, I was just going to ask Itai a question that I just typed out. So did they announce ahead? This is Rob Ross. Did they announce ahead of time they were going to do this? And if they did, how much lead time? And if they're going to do these bond funds, I mean, then what's next now that the camel's nose is under the tent? Like, will they go to equities? I mean, I guess the thought process is because they do interest rate type stuff, is they're going to prop up companies' bond holdings. Is that do they give any kind of guidance on what they're going to do, or expand from there?
So what I know, I mean, look at the performance of HYG J&K on Thursday. I mean, they were up anywhere between 6% and 8%, which is pretty insane once this was announced. I do think that it takes away. It's almost putting this in this artificial put options to these bond markets. I don't know how sustainable it's going to be in the long run. I don't think anybody does. But as far as I know, there's no direct schedule like you have with the QE POMO programs. I haven't seen a direct schedule, but this is so new. So we're still trying to find out how this will play out and how exactly they're going to buy it.
Do you know if any of these bonds convert to company equity?
I don't know if they're buying convertible bonds right now. I haven't seen anything to say. But again, this only happened on Thursday. So for now, I only know they're buying those ETFs as far as I could see in the research I was doing.
All right. So Itai, the markets have rallied quite a bit in the course of the past 2 weeks. Did investors miss the bottom?
Well, it's a little bit of a tougher question to answer now. Historically, I would say probably not. And I still think that's most likely the answer. But with this unprecedented level of policy intervention, it's harder to say. Nonetheless, if we look back at history, I think this is an interesting slide to look at. If we compare the Lehman moment in 2008 to the COVID-19 moment, or basically when these lockdowns start and we have this initial shock reaction and move down. In 2008 too, in 2008 November, QE1 was announced and a lot of policy response. And even though all that was announced, it still took a few more months until the bottom was eventually reached. We can go back and see in historical bear markets that it's very typical for the market to retrace about 50% to some of those finance nerds would call it a Fibonacci number, to 61.8, or about 2/3 of the move back up. So they would retrace those kind of stair step back up before leveling off and potentially continuing to go lower or explore the similar low they were in. So the short answer is, if history is any guide, and a lot of times it is, we can see that normally it doesn't do that, and we don't necessarily just go up in a V-shaped move. That's fairly rare for that to happen.
Do you have any charts that you can share to kind of talk about them a little bit?
Yeah, so I think the move that we've had right now, this kind of drop from 3,400 to 2,200, is fairly similar to 1987 as far as the velocity and the speed. Velocity was about 37% down. 1987 was very similar. We can actually look all the way back there. I actually know charts by heart, so there we go. That would be a similar move. The only difference is that Black Monday, of course, was the majority of it, was down 23% in a day, where we've had, I think it was down 11 or 12, close to 2 days in a row until we reached the bottom. Over here too, there was a period of volatility that followed before markets started slowly stabilizing and grinding back up. But we've seen this happening not only in sharp crashes like this, but in other more bear markets as well. I wouldn't necessarily call this a bear market. This is more of a sudden dislocation that eventually gets recovered, and the market recovers to a new high shortly. Also,
could you show us some of the bear markets then?
Yeah, absolutely. So going back to 2000 and 2008 again, it actually lasted a long time, starting in October of 2007, but the realization moment that the housing bubble is legit was probably with the Lehman moment that was right here. You can compare this moment to the COVID-19, and then eventually a period of extreme volatility between October and March. This is when all the policy response came in and all the QE programs, TARP and things like that started out as well. Even more recently, the US credit downgrade of 2011, right there, about a 20% drop, took a few months for up and down volatility before stabilization.
That sounds like visitors coming to your house.
I think my dog is a little upset about the market.
That's okay. That's okay.
Hey, Said here, just a comment and a question, if you don't mind. Now Powell, the chairman of the Fed right now, he's been quoted as saying that he didn't think that the Fed intervened quickly enough in 2008 with Lehman. He's kind of under the impression that all the fiscal or all the monetary stimulus should have been done then versus waiting it out. What do you think, if that's his philosophy, what do you think he's going to do when the markets start being unstable again and start declining? Is he going to be more aggressive? And he's already shown a history of being more aggressive. But does he have any more bullets left to be aggressive if things start to slip again?
I mean, that's the question, right? That's the $10 trillion question.
10 trillion now, I know.
Yeah, that's a 10 trillion. It keeps going up, every year we have to increase that number. So
a little bit under 50% of our current GDP. Yeah.
That's the scary part. How much can this financial monetization continue? How much can we buy these junk bonds and investment grade bonds, and just at some point we nationalize everything? Are we going to nationalize the stock market to just keep portfolios and 401ks go up indefinitely? So I think it's a real slippery slope at this point. I mean, we're just not, the policy making right now is just to not allow markets to do what they're supposed to do at all. And I think that's one of the bigger issues down the line. I think for investors, what we have to figure out in the short run is, hey, are we going to basically just have a short period of volatility and an incredible recovery to benefit from? Is this gonna allow it to happen, or is this it? And this is the moment the Fed can't save it. And I still think that they'll be able to save it this time because the level of the monetary infusion is just so great, and we're not at that Minsky moment yet. But that's my take on it.
So Itai, let's say you talk about like what other stops can the Fed pull out. You could always go down to negative interest rates, and there's a number of countries doing it. From what you've seen, how many countries have gone negative, and what's been happening in those countries so far?
So multiple countries have gone negative. We've seen it.
Do you have any idea how many?
Well, the entire European Union, the ECB, is negative. Denmark is negative. Switzerland is negative. Japan is negative. The Nordic countries that are not in the EU are negative. And we've also seen a bunch of negative yielding bonds, which is just stupid. But we've seen a lot of it, right? And the question is, how much stimulus could it possibly do more than what it already done? We've seen the performance of European banking stocks since, and here, let me try to pull one of them, maybe BNP Paribas. What's the ticker for it? BNP Paribas. So, forget my illustrations right there. And if we go here to a weekly chart, so, they've gone to negative yielding, their equivalent of the Fed fund rate a few years back, and the performance of European banks, I think this is a good barometer of it, has been pretty poor. And as of recent, they've literally gone to almost like 30-year lows. And I think a big issue is that in a negative yielding environment, it's very difficult for banks to make money. Very, very difficult for banks to make money. And if the banks are not making enough money, that's not good for the entire system, and it's not good for aggregate demand.
I think the philosophy of the Fed is that this is a social distancing influenced shock to aggregate demand, and they're going to do whatever they can in order to account for the social distancing costs of aggregate demand, and that seems to be their philosophy. Is let's just pretend that this shock to aggregate demand didn't exist. That's kind of what to me, that's what it seems like.
Yeah, I mean, what your comment before about what Jay Powell was saying, that the Fed hasn't acted firmly enough, he's definitely making up for it now, reacting in a very firm way, and at the same time, we're also having a very quick fiscal response, which makes sense that this crisis may not last as long as it would have otherwise.
Right, and the ultimate question though is is this a bear rally, or is this a new normal, or what? That's the guidance that would be useful, right?
Right. So I wanted to talk a little bit about the correlation between the stock market and the VIX, which I think was the next topic, and I think that will help answer that question. So if I bring it up here, and I compare this real quick with VIX, I think this is a little bit important because a lot of people have a notion of the VIX and they say, hey, you know, the VIX, the fear index, when it peaks out, that's usually when we bottom out. So very quickly about the VIX, it trades negatively to the S&P 500, but not at 100%. It's closer to 75 to 80%. And generally speaking, it's the pricing of options for future volatility. It's the pricing of future volatility expectations. I'm not going to go into the exact math of how to calculate it and what it says, but you can look at it as the demand for hedging and demand for options essentially in the market. And generally speaking, as the markets do trade up, the VIX trades lower as expectation for future volatility diminishes. As the markets trades down, this increases. But what I've noticed that is, I think it's an interesting observation, is that the moment of peak fear, which is the higher moment in the VIX, is not necessarily the moment of the price bottom as far as the actual S&P price is. You can even see right now that we've reached peak fear. It's March 16, and the near-term price bottom was actually on March 23rd. But we can go back to history to look at previous examples of this. And here's that 2008 market. Here is this Lehman moment. And we've reached about 80 on the VIX, which is very similar to what we've reached now. And a few months later, the price bottom in March of 2009 actually hits when the VIX is at 52, significantly lower. Again, the peak capitulation or peak fear comes in before the actual price bottom. But this is not just the behavior of the VIX in 09. You can see here in the flash crash in May 2010, peak VIX comes in in May 21st, and bottom of price comes on July 1st. US credit downgrade 2011, peak fear comes in on August 9th, and the bottom in price in October, 3rd of October, actually comes in on a lower VIX again. So I can go in many, many instances in history showing this. So again, the one caveat we have is an unprecedented intervention of the Fed, and maybe these historical precedents stop working. But if they do, here, by the way, this is, I think actually it's the same illustration, but we see that too in that 2015 Chinese devaluation. Peak VIX comes in August 21st at 40-ish, and actual more tradable bottom comes in September and a much lower VIX level. So then again, where we are now, we know where peak fear has been. The market has rallied since. History says we should have a few more months, maybe 2 to 4 months of volatility. We're going to establish some kind of low, whether or not it's going to be lower, whether or not it's going to be a little higher, whether it's not going to be somewhere here. But if the VIX does not, and I repeat, if the VIX does not reach those levels and stabilizes, let's say somewhere here, and then start trading down again, odds are, based on history, that we have a much more tradable bottom that we can position ourselves to.
So Itai, how does the Fed buying everything impact this?
Well, you know, you can make the argument that the Fed was buying everything when 08 was going on too, and they started the first QE programs in November. It still took a few more months to stabilize. QE2 programs were announced after the credit downgrade event took place, QE2, I believe. So it may take a little bit of time for the money to make its way in the system. But again, the level of intervention and ETF buying that we're seeing is kind of unprecedented. So we are running the risk that these historical precedences do not hold and we just shoot back up. It's probably unlikely nonetheless, because the economy is still shut down, and you know, there's still potential downside pressure to remain. So I guess we'll see. But I just wanted to show that if history is going to repeat itself, in one way or another, then we should prepare for more volatility.
Yeah. There was a question, Ed, you had one that you posted to the group. Do you want to share it openly?
Yeah, thank you. I'd be happy to. The question I had was Q2 earnings going to roll around and they're going to be bad. So do you think that that will increase the fear index and create another bottoming effect?
I mean, that would be the trigger that we would look for, right? I think a lot of people are expecting it though, but we know the earnings are going to be terrible and we're going to be watching for that. Potentially, that's what needs to happen, where we see a little more volatility and downside move here. But again, what you have to watch for is price going to go to the same level as it was or very similar? Is the VIX going to only go to 50 or 55 and not getting anywhere near the top? And then the market will start trending back up again. That may be a much more sustainable bottom than that initial one right here.
The one thing I'm hearing from a lot of managers is that Q2 is just kind of out the window. They're just looking for opportunities to pick up stuff that's misvalued or mispriced because everything's discombobulated. But, you know, with whatever the number of million of people out of work and everybody working from home or unemployed, Q2 is kind of just out the window. It's a matter of what's going to be Q3 and Q4. So I think Itay's right. It's just going to be this discombobulated volatility during the next several months. But Q2 is just kind of out the window as far as people trying to place value on anything or price earning ratios or anything.
So the issues of Q2 have been priced in already, along with unemployment. 30 million people unemployed. That's been priced in. But if we don't start seeing the curve flattening, and if we don't see earnings start to recover somewhat, and aggregate demand return in Q3, then the fear index goes up quite a bit.
Yeah, that's a fair point. So then again, that's why you know, it's probably too early to call a bottom and say we're out of the woods and everything is okay, which is you know, kind of the point I'm trying to make.
So Itai, if we're sitting here and we're saying, all right, you know, we're still, you know, a few months away from maybe a market bottom, you know, we're not too far removed from peak fear. What is something that you know, how could somebody go about trying to place a trade or do something on their own that could help them, you know, make money if that's the thesis that they have?
Right. So last time, one of the feedback items that I got was, yeah, well, this is all good and fine, but how do you express these kind of positions and potentially trying to make money of it? So I don't want to give any specific advice to anybody out there. But if I were to make a trade and I decided to try to benefit from this expected back and forth and potential move towards the lows and then potential recovery from the lows, there are multiple ways to doing it. One of the ways that I would look to do it is to use what we call a put ratio spread. And I don't want to go too deep into options because I know some people here have a more in-depth knowledge than others. But what I do know, you know, some people just tend to say, okay, I'm just going to buy a put and hedge a portfolio or what have you. And they have to keep in mind that when the VIX is at 50, the price of hedging can be very expensive. So just buying a put, let's say we wanted to buy a put at 2,400. The market has to go potentially significantly less than 2,400 because we're paying so much for that premium. And if it goes anywhere between here and above 2,400 by expiration, the put is essentially worthless. So it's not necessarily the best of hedges. What I'm trying to do is actually have something that makes me some money if the market goes towards this level, allows me to buy the market near the lows. And if the market goes higher because of all this Fed intervention, I don't lose any money. So I don't want to be directly in a short position. And the way I do that is I could potentially buy a put here at 2,400 and around the 2,240 area, which is near the lows, I can sell 2 puts for every one that I buy to give myself even credit, which means that these ones here pay for this one here. So if the market goes in this area right there, that's kind of where I make the most amount of money. If it goes a little bit lower and goes back up, that will be jackpot because it will actually assign me the equity that I potentially want to buy at those levels. So I want to go quickly into the Analyze tab to show you how this looks like. So I've already put this trade in, and the way it looks like right here, you can see the 2,400 put that I would buy. And right there, you see the 2240 put that I would sell. I would buy this for $33 and sell this for $16. With the bid and ask spread, it's more or less going to be a break-even trade. So you can see here on the right side, the x-axis. So let's go back quickly. X-axis represents.
And Itai, we want to be looking at this blue graph. This there, it's like a light.
Yeah. So this blue shows you the P&L at expiration, where this would just be the next day. So you want to ignore the purple line for this purpose. The x-axis represents S&P points, and this shows dollar P&L. So we can see the flatness of this blue line going all the way through to the upside. So if the market right now is at 2,700 and change, if it goes all the way through, the line essentially stays flat and there's no monetary loss, doesn't matter how much the market goes up. What's the fun part starts when the market goes down. A move between 2,400 and 2,240 actually makes us, I think it's the dollar here, it's about $150,000, $160,000, or actually says that in the blue here, $158,000 at the peak. Why is that? Because at 2240, the $2,400 put is $160 in the money, maximum gain. The 2240 that we sell expire worthless. But the market has to fall below 2,080 for me to actually lose any money here, which, I don't know, we closed at what today? Exactly
27 something, I want to say. Let's see. I'll tell you in a second. We closed at 27.61.
All right, so 2080 divided by 27.61. So the market has to fall 25% for me to lose any money here. Between now and the May expiration, that would be May 15th.
But it's also the way I also look at this is like you're almost cheering for it to fall even further, because then you can start getting that S&P exposure at a pretty low price. So if you're trying to force yourself into some type of dollar cost averaging, this is an opportunity for you to boom, get assigned some of that equity exposure, and you had an opportunity to make money even if it, you know, if the end price didn't get all the way down there.
That's kind of exactly the point. So if the market goes up here, no harm, no foul. If the market goes down the way we expect in the spirit of volatility between the recent lows, which were around the 2240 area, that's the recent low. So between 2400 and the recent low, it's all gravy train. And if it goes significantly lower to the 2000 level, I actually get assigned the equity. And I get to go long at that price. So in a way, anywhere between the recent lows and 2000, I get paid to go long the market at heavily discounted levels. So I would actually do it on the S&P futures. SPX is a European cash settlement, so nobody gets confused. But this is a good way to illustrate, because the ES keeps moving at this time, and I wanted something that actually doesn't move. So this is a way in which I would play something like this. The way I would express it. So
cool. Do we have any questions from the audience?
So are you looking, obviously you'll reevaluate, but you're looking at trying to put on these trades, like if you come to May and it's nowhere near it, then you might roll into the June for a month ago, then the July. This is just kind of your set play right now.
Yeah, I mean, think about it. These are costless. So worst case scenario, they expire, just roll it over to the next month, assuming we're more or less in the same range.
Actually, worst case scenario is you get a $1,000-point drop in the S&P. But
if we get a 1,000-point drop in the S&P, I would get long around 2,000, but I can also hedge this, because that would mean that the calls will be really expensive, and I can just sell calls against it as the market goes down to reduce my basis.
Makes sense.
Cool.
So you have to react, right? I mean, this is not a trade that you could just place and then just sit on till expiration if the market started going against you. In other words, I guess my question is, if the market goes up, you're covered. How about if the market does go down significantly? How would you react to something like that?
So in order for, if you look at the way the trade is, in order for me to lose money in the trade, the market actually has to drop below 2,080. So the market's trading at 2,700. You're talking about a 25% drop, which is pretty significant from current levels, right? And I make money between 2,400 and in 2280. So even 2240, I'm sorry. Even if it goes against me and drops to roughly the 2000 level, it doesn't bother me because I actually want to be short the put there because that's actually where I'm looking to get long the market anyway. And the better way of just saying, okay, if the market goes to 2000 and I just buy it there, because I sold the put, I get assigned the equity and I get to go along there. So it's almost like I get paid to do that. So
right, but you would get, let's say the S&P went to 2000, right? You would just get out of the entire position and do the opposite. What would you do in that case? Because
no, I would just let it expire and get me assigned. So, the way it works is that every put that you sell obligates you to buy the market at that price, right?
Right.
So every put is 100 contracts. So I get assigned a certain amount of S&Ps at a price level that I think is very, very good to be assigned. And what I could do from there on, I could continue to adjust the trade and things like that. Because I can sell calls against it to reduce my basis and turn it into a covered call. I can do a lot of things, but generally speaking, that would be a good way to express opinion like that, right? Because if you just decided, hey, I'm going long right now, you have unlimited downside exposure. If you decided, hey, I want to go short right now, you're having all these upside exposure to what the Fed is doing. This way, my upside is covered and 25% of my downside is covered. And that's very hard to do.
Got it. Makes total sense.
Okay, cool. Itai, do you want to hand the floor over to Mr. Edward Kim?
Yeah, unless there are any other questions for me.
I want to ask, how'd you pick those strike prices, 2400 and 2240?
Well, those are based on the view of where the markets normally trades past this kind of period of volatility. 2240 is where the recent lows were. 2400 is, where we would go, kind of like the midway area there. So it makes a lot of sense to be in the bulk of profits when that happens. And if we pierce through those lows, I get almost a 200 S&P point wiggle room or buffer area in which I can get assigned, because anywhere between 2240, I get assigned 10 contracts. So if it goes below those levels, I get that buffer to buy at a discount and get assigned where I want to be assigned. So it's just a way to give me a lot of protection and a lot of buffer, and set up for success in the best way that I can do.
Is using this strategy on an individual stock something you would try?
Can you repeat this? Sorry, I didn't hear it.
Could you use that strategy on an individual stock?
Well, potentially. I'd rather do it on the index because a stock can have unlimited amount of downside. So if you have a stock that a stock could have bad news and fall 50%, and you don't want to be in that position with this kind of ratio spread. So I see this carry.
The only caveat to that is if the stock closely mirrors fall and rise of the S&P 500, and it has done so historically reliably.
But it's still one company. It's not a basket. It's not a basket of 500 companies. So I wouldn't risk doing this with an individual stock for that reason. And I see Carrie says the ratio spread short volatility. It's absolutely correct. So the drawdown that he refers to, it's all a matter of allocation, right? If I allocate this to be once I get assigned, let's say a 15 or 20% of my portfolio becomes an equity exposure. If I get assigned, then the drawdown is really not bad. And at the moment of expiration, I get assigned those positions. If I had equity and my delta is 1, I would actually have a bigger drawdown. So I don't use this kind of ratio spread as a way to leverage it. I use it as a way to get a bonus and a buffer to kind of get assigned a position. It's in a way, to me, it would be a better way than some people will just sell puts to get assigned positions.
Yeah, generally speaking, when you're naked a put, you're happy to buy whatever at that price. And that's
right.
what I think Itai's saying. He's happy to get into that general market around 2,200. If it's a stock, like he said, it could drop 50%. And so the old school thought is when you're net negative a put, are you happy to be long the underlying stock at that price?
Yeah, that sums it up pretty well.
Thank you, Rob. Well, let's turn it over just because we're eating up some good time here. Let's turn it over to Edward Kim, our special guest speaker for today. Ed, could you give a little bit about your background and then hop into what you want to tell us about what you're seeing with your portfolio companies?
Yeah, I think some of you guys were part of the conversation a few weeks ago when I gave a little bit about my background, but let me just go back into it again very quickly. 15 years in buy-side investment banking, so I did a lot of middle market M&A. So I've seen a lot of companies, a lot of different industries being sold and being bought and being sold again once they're grown. But last year and a half, I've been with a private equity firm called Trivest Partners, and it is has 2 billion of AUM, and it has 30 portfolio companies, employing about 7,000 people. So in this whole situation, COVID-19 situation, we've been seeing the up and downs of the industry, but we don't really deal with stocks. We deal with real companies. So we have a foot and a half inside the real economy, if you will. So when Ite and I were talking, we thought maybe we should have a quick conversation about what's going on in the real economy and what we've noticed in the sampling of middle market sized businesses, which in my case is 30. I mean, in my private equity firm, there's 42 people. I don't sit in on all the meetings, but I have sat in on the meetings where we talk about the health of most of our portfolio companies. So,
hey Ed, sorry to interrupt you real quick. I feel like we got a home improvement situation where we're just getting the top of your face.
Okay, there we go.
There we go. Yeah, now we can see you perfectly. Okay, wonderful.
Okay.
Would you like to continue your thought?
Yeah, so as I was saying, thank you, Jeremy. As I was saying, basically, that's what we do. We look at, we have a segment of the market that we're looking at, and what we notice is that there's been a lot of effect aggregate demand. A lot of our companies have already been pre-designed with some protection to a recession, a mild recession. But I'd have to say that out of the 30 companies that we have in our portfolio, a lot of them are still in the green. We have 3 codes: green, yellow, and red. Only 2 are in the red right now, but a lot of them are in the green. A lot of them are in the yellow, and 2 are in the red. And what we determined to be kind of a stress situation for us is that we've already made the changes that we've needed to make as we face this great shock to the economic system. We've already borrowed against our lines. We already have cash on hand, and we've already furloughed employees. So of the 30 million that have filed for unemployment claims, there's some of our employees that are in there. Let's face it, that's what we've had to do. So even if a company's in the green or the yellow, it doesn't mean that we've done everything we can to put these companies on sleep mode, basically. Not all of them, but many companies are in sleep mode. For example, Massage Envy, which provides massage services to people, that's on complete sleep mode because you can't have people touching people now, Another business that we have, which is sending doctors to elder care centers to take care of their bed sores, that's also on sleep mode because of the fact that you can't send people to see old people right now on a weekly rotating basis. That wouldn't be a good idea at this time, the way this virus works. Another company, anything that's consumer facing has seen issues. A company that where you drive in and get your oil change for your car or SUV, that's had an issue. A lot of demand has gone down for that. But having said that, we have an oil change business that does oil changes for semi trucks and for logistics type operations. And that's been doing extremely well because our supply chain's getting fairly taxed. And then anything that touches healthcare has done well. Our company that does HIPAA compliance, for example, they make sure that patient information stays confidential. So even if somebody has COVID-19, goes to the hospital, you still have to respect their privacy, records. That business has done very well. There's going to be winners and losers in this economy. That's what we're finding out. And to help the losers are those that are kind of stuck a little bit. The federal government has done a lot of things to help the real economy. There's the CARE Act. There's deferment of Social Security tax. There's a deferment of the payroll tax and a ton of other taxes. And also it's a situation of if we don't have enough money, we're putting people, on unemployment and to take advantage of these stimulus checks because we don't have the cash flow to handle it anymore. But to prevent those people from rioting in the streets, that's the reason why we passed fiscal stimulus. So there's a little bit of that. I could go into a little deeper into some of the other companies that are having issues, but it goes to what we said. There's going to be a decline in demand overall, but certain industries are going to do very well. We don't have any companies that are in biotech. We don't have any companies that are in medical research, but I would imagine those companies are well positioned, not only to do well right now, but to do well after we flatten the curve and after we start to recover from this. So in terms of investment, philosophy, anything that's consumer facing, we feel as if it's going to accelerate the decline of brick and mortar consumer retail. It's going to probably increase the decline there, but it's going to help with biotech research. It's going to help with medical, a lot of medical things. Now there's parts of medical that are doing bad because people are stopping from doing elective type work. Urgent care is doing badly right now. Urgent care. Dentistry is not doing very well. Some of the people that work in dentistry, they're actually going to the hospital to help the COVID-19 patients. So going forward, people have to pick winners and they have to avoid losers. I think that's what the ultimate lesson is. But also another lesson is that a lot of government programs out there that's buffeting the fall, which will, I think, help with some of the fear index. And I think that will help alleviate some of the volatility, is that there are things that are being done to the real economy that is helping stabilize things. And we're taking advantage of as much of that as possible because as a private equity firm, we have the resources to do that. Now, small little businesses out there, I don't know about them. They may not have a retained relationship with E&Y and KPMG to find every single way to make money. Those people are probably in greater distress than someone like us, but they don't have as much. They don't have as much leverage on their businesses in many cases that we put on the business. So we probably need those type of services more than they do.
Ed, let me ask you this. From all these layoffs that you've had, first of all, doesn't the PPP program that currently exists turns into a grant in 2 months if you keep the payroll the way it is? And if it is the case, why have you laid off people?
You're absolutely right. And we've done it because some of our industries, some of our companies have gone to zero in terms of revenue. And that PPP program makes sense if your revenue declines 20, 30%, but if it declines to 0%, I'm talking 20, 30% decline, but if it goes to 0%, then it no longer makes financial sense to do the PPP program. It actually makes more sense to furlough these people.
So are the layoffs temporary until the economy kind of reopens, or are you going to rethink everything and say, you know what, we're just going to hold off on hiring for a while? And I think it's important, the answer for that, because what you're going through with your companies is something that I'm sure a lot of portfolio managers and other people across PEs in the entire country are going through. And the answer to that question is going to define how high of an unemployment rate we're going to have 6 and 12 months from now.
We've told everybody that we've furloughed, that we want them back, but the economic reality is that we have to see how things look in 2 or 3 months before we, fulfill that promise. The federal government has made it as easy as possible in terms of having savings and having programs. There's also another federal program for small businesses, and that extends to private equity owned companies. So it's done everything it can, but ultimately at the end of the day, it really depends on how quickly we flatten this curve, how quickly we get people working and consuming again. Because if we don't do these things, there's no federal program that's going to help us make it easy to hire people again, unless we get the economy going again, the real economy.
Do you have an example of one company that has gone to zero as far as revenue and one company that's actually doing better than it did before, if you have one in the portfolio?
I'll give you a company that has gone not to zero, but functionally zero, and then I'll give you an example of a company that's doing better than it ever has, and then I'll give you a kind of a median case. Very quickly, the company that has gone pretty much to zero revenue would be our Massage Envy franchises. That is 100% people going to a Massage Envy location and getting a massage. You just can't do that right now.
Right.
And so our only source of revenue right now for that business is asking people to continue to pay their membership fee. and how we're getting people to continue to pay their monthly membership fee is that even though you pay the membership fee and you don't get any massages, you're going to get free massages later. You're going to get more later. We're going to give you a coupon to get more massages later. And so because of that, we've been able to preserve some amount of revenue to keep the back office people employed. So the back office people are still being employed, but everybody that's at these locations that give the massages, they've been furloughed.
Guys, I got a quick question. Seeing some stuff related to PPP questions out there. Carrie asked, do those furloughed employees get paid when you get the PPP money? David, it sounded like you might have an answer there. Do you want to share what you've been seeing, being the founder of a company that's got a few hundred people?
Yeah. So the furlough, I mean, if you rehire them, they'll get the PPP money. Ultimately, PPP is a low interest short-term loan with the ability for it to be forgiven. And it's only forgiven if that money goes toward paying payroll, rent, or utilities. And so if you allocate the dollars elsewhere, they have to be repaid to the federal government.
And I would add to that, David, is that companies with 100 or 200 or more employees are going to understand that. They're going to have advisors that will help them understand that. But a mom and pop company with 10, 20 employees may not understand that.
No,
fair enough. I mean,
that it's not forgiven if they don't use it towards wages.
Was someone
David, do you want to say it again?
Yeah, you're saying that they may not understand that if they use it for something other than wages, it's not forgiven?
I don't know what these small, mom and pops are thinking, or who's advising them. I don't know that, but a lot of times they don't even know about these programs.
Well, we've got somebody on the line, Mike, who kind of oversees PPP implementations and consultation to a lot of venture-backed companies. Mike, do you want to chime in with any thoughts on that?
Yeah, I can chime in. And just full disclosure, I'm with an early stage venture firm, so I'm not actually overseeing the implementation, but I've been advising our companies on that. The PPP program in itself is specifically for payroll support. So there's two main programs for the CARES Act, right? You have PPP and then you have the EIDL, which is the Economic Injury Disaster Loan. And so companies that qualify, meaning they have to pass, still there's a gray area around affiliation, but have less than 500 employees and have to be able to prove that they were adversely affected by COVID, they can apply for both programs. The caveat there is if they are approved for both programs, the funding can't be used for the same thing. So one company can use the PPP program, which is specifically for payroll, to cover their payroll expenses, and the EIDL program can be used as working capital. And so a lot of mom and pop businesses are finding that EIDL is very helpful from a working capital standpoint. Most technology companies that are smaller than 500 employees, and some of our venture-backed companies in our portfolio, have only gone after PPP because that's the only loan that's forgivable. EIDL is not forgivable.
Hey, Mike, have you actually gotten feedback from any of the banks or from the SBA that
you've actually gotten approvals. We got a phone call back from our lender telling us that everyone has been getting reduced packages.
So great question. We've had a couple companies already get approved, but we have some that are still in queue waiting to hear back. As of now, we've had 3 out of our, I think we had right around 12 or 14 companies apply, majority for the PPP program. So most people have been getting approved, but also our fund, I mean, we're an early stage venture fund. So we have less than, we're on fund 3, which is a $100 million fund, but our AUM right now is less than 120 million. And when you aggregate what companies we have potential affiliation relationships with, meaning that we are active board seats, it's a handful, because we still have some that are either too small and too early, or some that are larger. So we're one of the unique funds that we pass the affiliation test, right? Because aggregated, we have like 364 employees across our affiliations in our portfolio. So some of the later stage tech companies, I don't know how big your company is, or depending on what kind of investors you all have, but some companies have struggled depending on what investors they have on their cap table, because those investors can't pass affiliation. Does that answer your question?
Yeah. I mean, it makes sense. And the few that have been approved, they've been approved for the full 2.5 times payroll.
Yeah, they have.
I would also add that what we're doing at our firm is that we're going back to our insurance companies, and we have bought disaster insurance, and we're trying to convince them that this is a disaster and they need to pay up, and we're getting pushback. So our legal group has been fighting with them to consider the COVID-19 as a disaster. So a lot of other people are probably doing that as well too.
Got it. Have you had any luck convincing your insurance companies to either lower or completely get rid of your premiums for your businesses that aren't functioning?
No, we haven't, as far as I know. But what we have done is that we're not getting management fees. Well, for a lot of our companies, we're not getting management fees, especially the ones that are struggling. And we've also tried to cut costs where we can.
Ed, what's your average leverage on these companies?
You
don't have to answer it if you don't want to.
No, I'd say it's about 3 times leverage on average. I'd say some of these companies have as much as 4.5 times because we might have recapped them and provided some liquidity to shareholders. Some of them we might have less than 3 times leverage, but I'd say the average is 3 to 3.5 times leverage, which is actually fairly conservative.
Yeah, I know for what you're doing, it's fairly conservative. Do you feel that you have the ability to defer payment on that debt, and how do you service that debt, and how do you feel that could you survive 6 to 12 months without making payments? Like how does your firm do when it comes to this?
We have been negotiating with our banks on covenants, renegotiation, as well as deferment and those things. So there have been some sensitivity. There's been more interest in deferring either the interest expense or the principal expense, but usually it's the interest expense. We're asking for a deferment until the end of 2020. That's what we're asking for, and we've seen some positivity to that. I think with the Fed's aggression has been helpful. Let's see here. What else? We're proactively negotiating new covenants levels till the end of the year. We're extending audits, and we're asking for a waiver of other payments, especially ECF payments. We're asking for that. Some banks have come, like I think I've mentioned this before, but the Canadian banks have been very, very nice. Nice.
Well, Canadians are nice, right?
They proactively came to us and said if we needed any help. So it's been easier negotiating with Canadian banks than it has with U.S. banks.
Right. So
Oh yeah, no, I was just gonna say, I know we can go on and on about this forever. Just want to be very thoughtful about everybody. So we'll call this the 5-minute mark. So we'll take 5 minutes more left. What I want to do is I want to open this up to Q&A really quick, where we can talk about Anything market related that the audience wants to discuss?
Or just anything in general.
Good point.
You know, guys, a lot of this really has to do with how well we flatten the curve, because we can talk about, you know, the data and what the Fed is doing and what stocks might do, but ultimately at the end of the day, we got to get people back to work, and we got to get the economy moving again. So a lot of it really depends on what kind of therapeutics we're going to have, how good we are at social distancing, and how social distancing will influence how people go out and spend money and go to work. So we're, none of us here are medical or healthcare experts, but at some point the conversation is going to shift to that direction, because if we can't get people working like they did before, then this is going to be a moot point, in my opinion.
And it's going to take time too, because, you know, I read this Morgan Stanley research today that basically said, hey, you know what, first of all, there's two big risks. If you let loose the economy too soon and everybody gets reinfected and we close everything right away, or you release it and everything seems fine and you get a second wave in the winter, which seems to be a very likely outcome as well.
Right.
Question I had, portfolio wise, is talking about the airlines. The one thing I heard as far as like Spirit and JetBlue is when everything was booking, they were kind of picking up the crumbs, because the bigger airlines like American and United, you know, Southwest, like of course the business class and the first class flyers, and JetBlue and Spirit were kind of picking up the crumbs. Now American and Southwest and all them are going to be, you know, basically picking up every crumb. And is that going to force out a Spirit or a JetBlue out of the market with no one flying, and then the big dogs now picking up everything and not leaving them any scraps?
Yeah, that's a good point. Unless the Fed is buying their bonds and giving them free money to keep afloat, right?
Nice way to circle back to the very beginning. Thank you.
I mean, our approach in terms of getting back to work is now just a new normal. So we've provided a subsidy for anyone to be able to buy a desk and chair. We've ordered double monitors, double docking stations, and the whole sort of setup that we have in the office for folks at home. And then now we're planning on an office that uses every other desk. So I think those are the sort of approaches that companies are going to take to get people back to work. I imagine that like we'll do temperature checks if that ends up being allowed too, so that people feel safe. So I recently watched Contagion, which obviously has a very different sort of mortality rate than COVID, but nevertheless, I thought it was a good analog for sort of what we're going through now and what could possibly be the way that we ultimately get back to normal, which is sort of everybody having to identify that they have the corresponding COVID-19 antibody or whatever COVID variant emerges. So
the other normal, yeah, and the other normal is how much of a percentage of people will now be working from home after this.
Mm-hmm.
This affects
a lot.
Yeah,
it
reverberates less travel, all that other kind of stuff.
Yeah, we've talked about it too, I think 2 weeks ago, and you know, what we thought would be a potential implication actually is the office real estate market and what that could do, but that's a totally different discussion.
David, question for you. Let's say it's successful and you see same level of productivity from your employees even working remotely. How does that change your need for the prime Chicago office space, or your future plans for needing it?
I've always been a big believer in offices, but having seen what I've seen over the course of the last month, sort of as a forced experiment, I'm encouraged by being able to build an entirely distributed workforce. So I think that other folks are seeing it too, and I've talked to other entrepreneurs who are attempting to dump their real estate.
Got it. Are there any of the other entrepreneurs on the call who are in a similar type of boat where they're reconsidering their office plans going forward?
Jeremy, one quick data point that we've seen across our portfolio of about 24 companies, we have a couple teams that were already distributed before this. And so all of them said, hey, this is business as usual. We've been training for this. But the ones that weren't, no one has come to us and said, hey, after this, we're going to fully dump our office space. But the majority have said, hey, we might downsize our office space. And more importantly, we're going to be open to hiring remote. So these are companies that in the past, they might not have looked to hire key executives unless they were in the same city. But they said, hey, our entire team, we still can't wait to get back into the office. We're excited to be in person. But based on what we have now, we're thinking a more flexible work from home policy. We're thinking about hiring remote executives, right, and letting them travel in. So I think that's going to be a trend that we're at least starting to see in the early stage software space.
Yeah.
Scaling that.
And that's something, I think that's the intersection of a trend that was happening before, where for all the people that aren't exposed to Silicon Valley, the prices of getting great talent out there are just so astronomical now, where for years, and there's some of the entrepreneurs on this call who are experiencing it, for years, there's been a number of these new high profile companies starting distributed from the beginning. So I think kind of the intersection of that trend now with this, I think the next generation of tech companies are way more likely to be started distributed and to run it there. And I do think that there's going to be big implications, because when you look at, the companies that have been growing fastest, getting the largest investment dollars, it's been those technology companies. So, I'm definitely, I sit here in downtown Austin, I see all the skyscrapers going up all around me. I'm just not as bullish about the future of office space. I think that, I think that a lot more teams are going to do it. And it's not just because of the COVID, it's more of an issue of the cost of the salaries to get great people. I mean, David, you've got an entire team out in Dublin, Ireland, because of this type of thing. So I'm just trying to connect the dots here. And that's kind of like one of the things that I'm seeing piecing this all together.
And Jeremy,
Richie. So your homework is to figure out what kind of REIT holds the most amount of office space and which one is most highly levered.
That can be done quickly. Let's short it.
Yeah, and tagging on to that, I know that 5 minutes, Jeremy, is up, so just being mindful of everyone's time. But I don't have as much experience, obviously, with these bigger companies that have these huge teams and so forth. I just have a tutoring company, and I'm the only employee. But I just gave my 60-day notice for my office space lease in Houston literally today. I sent an email to the landlord because my lease was up, and he asked me if I wanted to renew. I said, no, it's only 1,000 square feet. But I think a lot of these 1 to 10 employee companies where there's not necessarily a big team, it's just people doing their own independent work, like these really small office buildings that are maybe just 2 stories or something, and have a lot of small businesses. They're realizing that they can do the stuff from home, because literally every one of my clients has been like, hey, can we just start tutoring online? So I went to Best Buy today, got my virtual whiteboard, and I'm going to start tutoring tomorrow from my computer. So like, it's I feel like there's a lot of small businesses that are going to realize they don't even have to pay $1,000 a month in rent. They can just do it from these Zoom videos, like all of us are doing right now.
So the $1,000 a month in rent is hardly the case. I think people are paying a lot more, right? And they're I agree.